What's up guys, it's your boy August BTC back again with another video. Today we are going to do a guide. It's going to be a very interesting video. I'm basically going to teach you guys the basics of crypto options. A lot of people have been asking me, to kind of tone it down a little bit for beginners, just to explain what crypto options are, where to trade it, and just to explain the dynamics of it and how it works. So that's what I'm going to do today, guys. So please feel free to pause the video if you guys need to understand a certain concept. Feel free to go research it up as well. I'm going to try my best. This is going to be a part one, and I think there will be a part two. I'll just try and keep it between part one and part two, maybe a part three, not too sure. But yeah, so if you guys enjoy the content, please subscribe, drop a like. It will really help the channel grow. Share the video as well. So as you guys know, I'm trading options on crypto options on Deribit. And I'm just going to explain how Deribit works, what kind of contracts do I trade and things like that. So this is obviously the TradingView platform that I use. It basically tracks the price action of Bitcoin. So you can basically put the watch list that you want here. So Bitcoin is currently sitting on 64,000, pretty flat, down 1%, and we're still below the 200-day moving average. And yeah, so anyway, so where do I trade crypto options? So the best platform to trade crypto options, guys, is on Deribit. Okay, so Deribit is one of the best crypto exchanges out there. It has the largest volume when it comes to crypto options, specifically when it comes to Bitcoin and Ethereum, right? It's very liquid. Institutions uses it, and it's a massive exchange, probably the only best exchange out there when it comes to crypto options. So this is the exchange, guys. So this is a demo account that I'm running here just to show you guys, the platform and how it works. So I just put $5,000 here. Again, this is demo money. This is not real money. So I don't have this $5,000 sitting here. The goal of my main channel is to trade my account from $1,000 to $10,000. So I just had to put this amount just to show you how things works here on Deribit. So this is Deribit, how it works. As you can see, Bitcoin is a price, Ethereum, and I currently have the value. I don't have any Bitcoin and Ethereum, but I have 5,000 USD. And you can create a tab here, right? That I've created here. Once you come here, it brings you basically to the options chain, which is what you see here. So this is a Bitcoin options chain, and there's also an order form. So the way to open this, you can basically, it's not really user friendly, I'm not going to lie. It can be a little bit intimidating, but with time, if you go through it step by step, I will probably do a tutorial on how to use a platform fully on a later stage. But for now, I just want to explain the basics. Okay. So the next thing, what is a derivative? A derivative is just a contract, right, whose value comes from something else. So in my case, I'm basically trading Bitcoin and Ethereum contracts, right, where I don't necessarily own the coin, but I'm trading the contract. Okay, so I'm trading options, I'm trading perpetual contracts, and I'm basically betting on the price, betting on whether the price is going to go up or whether the price is going to go down. And based on that, I'm creating strategies to help me print or make money. So that's the goal. So that is what derivatives are basically. And as a result, what kind of derivatives are there? The first one is a perpetual contract, which is a perpetual future. So a perpetual future contract is basically a bet on a price with no expiry date. So it's a contract that has zero expiry date. So you can hold this contract forever, right? And you can again bet on the fact that the price can go up or the price can go down, and you can hold this contract forever. Now, the reason why one would use a perpetual contract is because a perpetual contract has leverage. It's highly directional, meaning if you are right about a certain direction, whether up or down, you can make a lot of money if you're right. And you can also lose money if you're wrong. So let me give you guys an example. So this is my portfolio, the dashboard that you guys have been seeing here, right? I am trading on Deribit, but I created a separate dashboard because it just makes things a little bit easy to read, for me and for the viewers as well. So this is an example of a perpetual contract that I have here. So I have this contract of Bitcoin, and the size of the contract is 0.12 Bitcoin. So if you take 0.12 and you multiply it by the actual, because one Bitcoin is valued at $64,000, so 0.12 would be about $6,000. 6,000 $200 or $500, something like that. Okay, so that is the size that I have here. So if Bitcoin goes up, I'll be making some good amount of money as well. Okay, so that's basically how it works. Okay, and the average price that I got in here is at 61,200. So same thing with Ethereum. I have a perpetual contract that will never expire, and my goal here is to try and increase these positions as much as possible so that I can make money, a lot of money. So the bigger the size of this perpetual contract, the bigger the amount of money that you'll be basically making. So that is what a perpetual contract is basically. So now let me show you quickly on Deribit how to open a perpetual contract. So what you need to do, you need to go to the order form. Okay, you need to open up an order form. I'm not going to get into how to do it, but you need to, maybe later, you need to open up an order form and then open up a BTC USDC perpetual contract. USDC so that you can get paid in dollars, in USD. Okay, so now what is the size? I'm going to open up 0.1 Bitcoin, right? But before I do that, I want to show you guys something. So 0.1 Bitcoin, guys, is currently valued at 6,400. Okay, and remember I said I had 0.12, so I actually have about $7,600. That's the size that I have in my actual account. So remember, the account that I have, this is the available balance that I have in the account, 5,000. So, but look here, this, to open this position, I would need $7,000. Okay, but then the beautiful thing is Deribit uses portfolio margin. Okay, this is it here, cross portfolio margin. To enable it, you just click on here and then you click on change margin, and then you see all the different types of margin here. Okay, so what is portfolio margin? Let me quickly explain that to you guys. So portfolio margin is how Deribit decides how much collateral you need to hold instead of checking each position separately. So it looks at your whole account together, it stress tests it, and against a lot of mathematical, hypothetical equations, whatever the case may be. Okay, so in a nutshell, to explain it, right, the way that I understand it is basically portfolio margin helps you use very little collateral to have big positions, especially if you know what you're doing, right? So you can trade big positions with little money, and portfolio margin will basically stress test a lot of scenario and will basically, how can I say, enable you to trade those big positions with little collateral. So this can be highly beneficial, but it can also go against you if you don't know what you're doing. Okay, let me give you guys an example. Very quick example here on Deribit. So we are on XPM. Again, XPM here is portfolio margin. Let me go back to the main account. Okay, so if I put one whole Bitcoin here, guys, to be able to trade one whole Bitcoin, I will need $64,000, right? Which is crazy. I don't have that amount. So if I actually open up this position, this whole account won't be able to do it because, right, I only have 5,000 available balance. Although the margin that you see, it's calculating how much margin is going to use to open the position, which is about 1.7. But if I click buy, it's actually going to go and buy. I'm not too sure. But if I do it, you will see how this amount is going to go very high, and I don't want to do it right now. We're going to do an example on a later stage. But to be more realistic, I want to open 0.12 Bitcoin, right? So still, I only have $5,000, but the margin, look, it's only going to use $200. So portfolio margin is very capital efficient, guys, if you know what you're doing, right? So I'm going to open 1.2 right now, a market order. And look at my maintenance margin. It went up just a little bit, 17%, and it used about 21% of margin to open up the position. So I still have 4,000 of available balance left here. It used $200 to open up the position, and here's a position here. Okay, so now I'm controlling $7,000. Let's try and increase it a little bit more. Let's do another one, 0.1. Let's add on what we have. You see how this went up again. So I like to keep this below 50%. Very important, guys. So now I'm controlling $14,000 of Bitcoin, which is 0.2, and yeah, and it only used about 39% of my available margin. Now I only have $3,000. So that's basically how portfolio margin works. Okay. So next topic. Now, let's talk about a call option. What is a call option? A call option basically gives a buyer the right to buy an asset at a fixed strike price before it expires. So if the price goes above my strike price, the call gains value fast. If it stays below the strike price, the buyer loses the small premium paid. So let me give you guys an example of what a call option would be in my portfolio. So you see all these C's. All these C's are basically call options, right? But then there's different types of call options. You can either buy a call or you can sell a call. Okay, and the next topic here is a put option. So a put option gives the buyer the right to sell at a fixed strike price. It gains value as the price falls below the strike price. So think of it as insurance for position. Okay, so here we are on the options chain here, guys. So you will see on this side this is calls, and on this side this is puts, right? There's two ways of seeing it. Okay, so you can either buy a call or sell a call. You can either buy a put or sell a put. Okay, so this is basically how it works. So you can either buy or sell a call, or buy a put or sell a put, and all of these things have different functions. But I just wanted to explain what the basics of what it is. Now, when you sell a call, for example, when you short a call, right? Selling means writing, right? So when you sell a call, it basically means you collect the premium today in exchange for capping your upside. So if the price stays below the strike price, you keep the whole premium as income, and above it, your gains are given up. Above that level, you lose money. So selling calls, you see a lot of people saying they're selling covered calls. So when they sell calls, that means they're getting paid upfront. A lot of people like selling calls and selling puts because they get paid. All right, so that is what I'm doing here on my position. You will see all these positions here have a minus in front of it, right? Anything that has a minus in front of it here, when I open the position, that means I'm selling. And once I'm selling, this is how much premium I received. So I received $100 here, 124, 102, 160. Okay, same thing here. I sold these two positions. I received $28, $55. So that is what selling means. So for me, I like to sell calls, and I want to focus on selling. I don't really want to focus on buying for now, maybe in a different video. I want to focus on selling for this particular video, right? Maybe part 2 we'll talk about buying. So selling is very important, because when you sell, you receive premium, you get paid up front, and I like to get paid. Imagine every single week, guys, this is how much money you collect every single week. Wouldn't that be nice? Like, for instance, this is how much I've collected, and this is how much I stand to make in the next 42 days. So if the price stays at this level, I stand to make this money in the next 42 days. So let me explain to you how it works on Deribit. So if you want to sell a call, you simply just need to come to this call side, and you need to choose a very specific strike price. The strike price is basically the price that you see here. Now you need to be very strategic. You need to know your asset. You can't just go blindly and sell a call, right? You need to know why you're selling, when you're selling. Let me give you guys a very simple example. So I'll come here, for example, and say, okay, we're in a bear market. Because we're in a bear market, the last time Bitcoin got rejected here at this 200-day moving average. This is some technical analysis that I'm doing. So then what I'll do is I'll say, okay, there's probably a chance that Bitcoin will test this level again and get rejected. And this level is 73,000. So what I'll do is I'll sell a call at that particular level. Okay, so to sell, all you have to do is you have to come here, like I showed you guys on the previous video. Sorry, on the chart, right? I want to sell at this level. So what I'm going to do, I'm going to come here, and I'm going to look at, very importantly, before I come here, I'm going to look at the bid and ask price. Now, because you're selling, right, you need to look at how much the buyer is going to pay. All right, the person that's buying from you, how much are they going to pay you, right? So you're selling, how much are they going to pay? And this is how much you're going to pay for one contract. So if you sell one Bitcoin, you can literally receive $480. But I don't think this account can take one Bitcoin, which is a little bit too massive. So let's try and do that. Let's try and sell one Bitcoin. I don't really think that'll be doable, but let's see if that works. Okay, so we were able to sell one Bitcoin. So the reason why my margin didn't go as crazy is because I'm using a portfolio margin. So to show you guys how that happened, if I go here, right, this is how much I have now. But if I go to the transaction log, you will see here, you would have seen if I go to, yeah, you should see the cash flow. There we go. So I sold 1 Bitcoin and I received this amount. This is how much I received. Okay, this is how much I received. So if you take this amount and you put it in a Bitcoin calculator, it should give you about 500, close to $500 that I received. Okay, so if you take this amount, let's take this amount and then you put it here. Yeah, there we go. So this is exactly how much money you received into the account. So this is basically the beauty of selling options. So if you could do this consistently, guys, you can literally sell a lot of options, right? And get this amount of money, about $450 for one leg that I just sold here. So if I go back to my positions, okay, so now I have a perpetual contract, right? So if Bitcoin goes up, this will be basically go up in value. But if Bitcoin goes down, right, I'll basically be gaining this, you know, $450 or $80. So that's basically how you sell an option. You can do the same thing. You can sell a put as well, where you do the same thing, but on this side of the equation, where you basically just come here and then you click here and then you sell a put. Okay, so this is a put, right? So if I sell this put here, if I sell 1, I'm going to receive this amount, but I don't want to sell 1 because it's going to be a little bit too heavy onto the account because I already know. So I'm just going to sell, let's say 0.2. Okay, sell. Okay, so I sold 0.2 and I received additional money into the account. If I go to the transaction log, you will see here on BTC, I sold a put, as you can see, and I received another green amount of cash flow. All right, so that's how much I've received into the account. So that's a beautiful thing about you know, selling puts and selling calls, right? So next topic is the bear market, and that's where I'm going to stop. We're in a bear market, guys, and why are we in a bear market? A bear market is basically a sustained downtrend, right? So it's basically where the price just continuously fall. Even though the price will pump for a little bit, it will also fall, you know. So there'll be more downtrends and uptrend, okay? And another nice way of seeing it is by looking at the technical indicator, right, which is a 200-day moving average. So the 200-day moving average confirms that we're in a bear market if the price action is below the moving average. So this is what we've been looking at the whole time, guys. Okay, so the price action of Bitcoin is below the 200-day moving average, and this confirms that we're in a bear market. Very important, very important, very important. So I'm going to stop here for today, guys. And again, I don't want to make the video too long, but I hope you guys understood a little bit of concept, especially when it comes to, you know, selling. So just to quickly recap again, I have a perpetual contract here on Bitcoin, meaning if Bitcoin pumps, I'll be participating in the capital appreciation. But if Bitcoin goes down, because I sold the call, Bitcoin just needs to stay below, especially when it comes to the calls. Bitcoin just needs to stay below 67, 68, and 69K, and I'll be keeping all this money here, right? It's about $300 that I'll be keeping here if that happens. Okay, so yeah, I hope you guys like the content. I'll keep on explaining to you options in part 2, a little bit more detail. But yeah, if you guys like the content, drop a like, share, and I'll see you guys on the next one.